Hello and welcome to our video on the essential takeaways from Chapter 4 of The Intelligent Investor by Benjamin Graham. In this chapter, we will explore the concept of a defensive investor, discuss principles of portfolio diversification, and how to reduce risk while still making money. By following these principles, you can create a successful portfolio management strategy that is tailored to fit your investing style and financial goals. Benjamin Graham's defensive investor. In Chapter 4 of The Intelligent Investor, Benjamin Graham outlines the core elements of a defensive investor's portfolio policy. A defensive investor is someone who follows a strategy that promises the safety of capital and a satisfactory return, with nothing more than average intelligence and skill. Graham's core takeaways for defensive investors include: only invest in stocks that are so strong and stable that you don't need to worry about potential losses or volatility in the market. Invest in at least 20 different stocks for diversification. Limit your investing to large companies with established records of earnings and dividend payments. Set stringent criteria for buying and selling stocks and establish maximum acceptable risks. Do not buy stocks solely because they appear cheap. Look for quality, not just price. Do not make frequent changes to your portfolio. Only make changes when necessary or when opportunities arise. 25/75 Rule: splitting bond and stock allocations. One of the key takeaways from Chapter 4 of The Intelligent Investor is the 25/75 rule of thumb. This is a great starting point for a defensive investor, splitting your portfolio between 75% stocks and 25% bonds. This split allows you to capture some upside by investing in stocks while also protecting your investments with bonds. By following this 25/75 ratio, you can maintain a balance between risk and reward and thus make a better informed decision when it comes to investing your hard-earned money. Savings bonds and other asset types. In Chapter 4 of The Intelligent Investor, Benjamin Graham discusses the importance of diversifying investments and how to go about selecting the right asset types. He emphasizes the value of having a wide variety of investments, including savings bonds, but also warns investors of their potential risks, which include inflation, stock market fluctuations, and interest rate changes. Savings bonds are particularly popular because they offer a safe form of investment with minimal risk and can be used for long-term or short-term goals, such as college tuition or retirement savings. Along with savings bonds, Graham recommends an allocation of no more than 75% in other asset types, including common stocks, corporate bonds, real estate, and mutual funds. This mix will help protect against short-term losses and provide an overall portfolio balance that is diversified enough to withstand the volatility of the market. Stocks: low risk and long-term gain. When it comes to stocks, Benjamin Graham advises taking a low-risk, long-term approach. He outlines 4 key points to consider when creating a portfolio of stocks. The investor should select only those stocks with quality and value, those which have consistent earnings, pay dividends, and have low price-earnings ratios. The investor should focus on creating an income portfolio that includes diverse stocks from different industries, with the intention of generating a steady income from dividends. Investors should diversify their portfolio by buying stocks in different combinations and with different maturities in order to minimize risk while still generating the maximum return possible. Finally, the investor should ensure that they are not buying too much stock or overexposing themselves to any particular company or industry.